Hey, if you're in a business partnership, I guarantee you've asked this question. When tax time rolls around, how do we actually split the profits? You'd think it's simple, but you know what? This one little detail trips up so many entrepreneurs. So let's imagine your new business is a hit, you're making good money, and you and your partner agreed from day one, 50-50, straight down the middle. So at the end of the year, you just take the total profit, cut it in half, and you're good to go for your tax returns, right? Well, hang on. It's not quite that easy. See, the thing is, the tax authorities have a very specific way of looking at this. So today, we're going to follow the money. We'll trace the journey of every dollar of your profit, step by step, to see how it's officially calculated and split between you and your partners. Okay, so with any puzzle, you have to have a starting point, right? A corner piece. For partnership taxes, that starting point is a very specific, official number for your total profit. It's the rock-solid foundation for every single calculation we're about to do. And that starting number has a name, Provisional Adjusted Income, or PAI. The easiest way to think about it is this. PAI is the total taxable profit the business itself made. It's the whole pie before anyone gets a slice for things like a partner's salary or interest on the money they put in. To make this super clear, let's put a number on it. We'll say our example partnership has a provisional adjusted income of 227,000 ringgit. Now lock that number in your head because everything we do next starts right here. All right, now for what I think is the most important step, what I call the great separation. We have to separate the money that's paid to partners for specific things, like their salary, from the actual true profit that's meant to be shared. And trust me, this is where almost everyone gets it wrong. Now you're probably thinking, hold on a second. If I pay my partner a salary, isn't that just a business expense, like paying any other employee? And that is a totally logical question. But from a tax point of view, the answer is nope. For partnerships, a partner's salary isn't a deductible business expense. It's seen as an early piece of their profit share. And that leads us right into our next big term, divisible income, or DI. This is the amount of profit that is actually available to be split up based on your profit-sharing ratio. It's what's left in the pot after you've taken out those pre-agreed payments like partner salaries and interest. Let's put it this way. PAI is the entire pie the business baked. To get to the divisible income, you first have to carve out the special slices that were already promised to the partners, like salaries. Whatever is left over after that, that is the divisible income, and that's the part you split according to your 50-50 or 60-40 deal. Okay, enough with the theory, right? Let's see how this actually works with a simple case study. This is going to make it all click into place, I promise. So let's meet the ABC partnership. We've got partner A and partner B. Their agreement says they share profits 50-50. Simple enough. But, and this is key, the agreement also says partner A gets a fixed salary of 30,000 ringgit, and partner B gets 5,000 ringgit as interest on their capital investment. That partnership agreement, folks, is the rule book. The math here is actually super straightforward. It's just 3 steps. First, we take our starting number, the PAI. Step 2, we subtract partner A's salary. Step 3, we subtract partner B's interest payment. And whatever's left, that's our divisible income. So let's plug in our numbers. We start with our PII of 227,000. We take away the 30,000 salary for partner A. Then we take away the 5,000 interest for partner B. That leaves us with a divisible income of 192,000 ringgit. This is the number they will actually split 50-50. And here is the grand finale. Look at this. Both partners get their 50% share of that divisible income, which comes out to 96,000 ringgit each. But we're not done. Now we add back their special payments. Partner A adds their 30,000 salary for a total taxable income of 126,000. Partner B adds their 5,000 interest for a total of 101,000. So look at that. Even with a 50-50 profit-sharing deal, their final taxable incomes are completely different. So let's bring this all home. What's the big lesson here? What do you, as a business partner, absolutely need to remember from all this? The whole thing flows in one direction. Your business generates the PAI. From that, you subtract partner payments to find the DI. Then that DI is allocated based on your sharing ratio. And finally, you add those specific payments back to figure out each partner's final individual taxable income. That's the formula. And just a few final rapid-fire notes. Drawings, which is just you taking money out during the year, isn't a tax event. Think of it as an advance on profit you'll be taxed on later. Second, if your business has a bad year and your divisible income is actually a loss, you can use that loss to lower your taxable income in the future. And finally, if a partner joins or leaves mid-year, you just split the income calculations into different time periods. Simple. And remember, this isn't just some random accounting rules someone made up. In Malaysia, following this exact process means you're complying with the law, specifically Section 28 of the Income Tax Act. So getting this right isn't just about good bookkeeping, it's about staying compliant. Which leads me to my final and maybe most important question for you. Everything we just walked through, the salaries, the interest, the profit ratio, it's all controlled by one thing, your partnership agreement. So the real question is, have you looked at yours lately? Is it clear enough to handle all this? Or is it maybe a little too vague, leaving you and your partners open to a world of confusion, or even disputes down the road? Something to think about. Thanks for tuning into this explainer.